We are. All right, welcome everyone to the second installment of Aaron Wilson and Ben Brown's Grain Market and Climate Outlook. I'm sure they're going to have some updated information from our last meeting in January. My name is Kelly Tronosky. I serve as AEDE's Communications and Outreach Manager. So glad you're here. This will be recorded and posted on our website after we're done. This Winter Outlook series has been going for over 40 years, and it served as the premier forum related to Ohio's agriculture and food industry when it comes to economic analysis and outlook. So we have a few more outlooks over the next few months. We have an outlook on food waste. We have an outlook on food systems. And I will share our website so you can go and look at and access and register for all of them. Just a little bit of housekeeping. If you want to submit questions, you can do it through the chat function or the Q&A. We'd like to answer all your questions during the webinar. And if for some reason we have a deluge and we can't get to them all, we will have them answered and up on the website. The other thing is we have an evaluation that will come on your screen as you exit the webinar. We plead with you, please, to fill out the evaluation. It really helps us gauge the success of this program. If we are meeting educational objectives, it helps us identify future topics of relevancy and importance to you. So please do our survey. And without further ado, I'm going to introduce Aaron Wilson. He is an atmospheric research scientist with a joint appointment between the Byrd Polar and Climate Research Center and OSU Extension at The Ohio State University. Aaron focuses on the intersections of weather and climate with agriculture, engaging the community with outlook information to improve decision-making and climate change awareness and adaptation. Aaron encourages everyone across the rural to urban gradient to think about your climate change and how changing weather extremes are impacting you where you live. So Aaron, thanks for being here. I'm gonna mute myself and you can take over.
All right, thank you, Kelly, and thank you so much, everyone, for joining us today. Really in this, our second look at kind of the climate and the grain market throughout the winter season. You know, this winter has been pretty interesting for a lot of respects, and we'll get into some of the weather and climate aspects, but certainly weather is really grabbing the headlines here this week, and we'll talk a little bit about this outbreak, this Arctic outbreak that we've had settle across the country. Does certainly offer opportunities for some gorgeous settings out there. This is a couple of weeks ago here in Central Ohio when we had some overnight freezing fog and some thick hoarfrost or rime on our trees, and just beautiful sunrise and sunsets a couple of days here. But of course, it has taken a little bit of an uglier turn this week when we intersect humans and a big, brutal Arctic outbreak as we've seen. So we'll talk a little bit about that today. Let's start with the January recap. Just looking at the temperature recap from the month that was January of 2021. What you're seeing on the right-hand side, these are state rankings, statewide average temperature rankings. So what was the average temperature for the month, and how does that rank in all years since 1895? And so what you see are a lot of orange and beige shadings here, indicating that much of the country was above to much above average. Across the northern tier, the northern Great Plains, for instance, a lot of those states were near their record warmest January on record. Here in Ohio, we were the 30th. This was our 30th warmest January on record, again, going back to 1895. So very warm across much of the country, and that was really continuing from December, as we talked about last month as well. From a precipitation standpoint, not surprisingly, some areas picking up a little bit above average and others kind of on the dry side. This was the 40th driest January on record for Ohio. And if you joined us last month, I talked a lot about La Nina conditions, which we're experiencing, and I'll hit those again later today. But typically during winter, especially after the first of the year, the pattern turns pretty wet across the Ohio Valley. We didn't see that for much of January. Now it's kicked in relatively well, I think, over the last couple of weeks. We've had quite a bit more moisture that you'll see in a moment. But January was our 40th driest, and much of the Great Lakes and Northeast was dry, as well as out in parts of North Dakota, Montana, down through the intercontinental West, and also in the Southeast. Wet conditions prevailed really in the central plains from Nebraska to Oklahoma, and then through Missouri and Illinois as well. And that actually provided a little bit of relief in parts of central Illinois and northern Missouri. But what are we talking about this week? Very, very different conditions have settled across the country over the last 2 to 3 weeks. And certainly this is one, you've heard a lot of talk about the polar vortex event. I do want to spend just a moment talking about that. Now, polar vortex really defines the upper level jet stream across the Arctic. It's a persistent, and it's a pattern, an atmospheric phenomenon that we have all the time. There are times when that polar vortex is a little bit more relaxed, and what that allows is a little bit more cold air and cold air outbreaks to surge into the U.S. Much of this season, we've had a couple of events, about 3 events this year up in the Arctic that really kind of dislodged some of that polar vortex, some of that very cold air. And it was just sitting there at the border of Canada and the northern United States. But we didn't have a lot of snow cover across much of the country for January and February. For December and January. And that cold air, any cold air outbreaks that were coming across our country, we couldn't really sustain that cold. Once we started getting a little bit more active system from La Nina conditions primarily, or at least reflective of a La Nina condition, we had a lot more snowfall start falling across the central plains in the Ohio Valley. And that allowed that cold air to really start to spill down into the region. We had a very amplified, what we call an amplified flow. So that cold air really surged down into the central part of the country. So on the left, we're just looking at the average minimum temperatures this week between the 15th and the 18th. And so you can see parts of northern Minnesota, the average overnight lows were in the sub-zero category down to minus 45. And sub-zero really stretched all the way down into northern Texas, much of Missouri, Illinois as well, in terms of overnight low temperatures averaging in that 0 to minus 20 degree range. Very cold temperatures, below freezing for much of the country. And on the right-hand side, this is the last 7 days looking at the comparison to average. And we've really maxed out the screen here. If you look at the scale, maxed out the scale, all of those central states, 25 to 30, 35 degrees below average, sometimes 40 in some locations, just breaking all-time record lows. So a very impactful event. Unfortunately, I think this morning I heard up to 56 people had died already from this event. So very impactful, and certainly having some impact on some other variables that we're concerned about from an agricultural standpoint as well. Livestock, keeping livestock alive, calving season and the dangers that come along with that as well. Places that have snow, avoiding some of the frost depth, but areas that did not have snow, and basically there is a small area, North Dakota, South Dakota, without snowfall, really sending those frost depths pretty low as well. So, there's a lot of impacts from this event, and certainly a true Arctic outbreak this week. So if we look at the temperature differences compared to average over the last 7, 30, and 60 days, compared to our long-term average of 1981 to 2010, you can see much of the Great Lakes, much of the upper Midwest and Midwest Ohio Valley region well below average. Again, looking 5 to 15, even 25 degrees below average for many states. And so over the last 30 days since we joined you last time, things have been cold. Here in Ohio, between 3 to 6 degrees below average, but much more below average there across Iowa, Missouri, Illinois, and parts of the Midwest. And then looking over the last 60 days, again, December, January were quite warm. Taken in total, still pretty warm around the Great Lakes region, above average in much of Michigan, northern Ohio, northern Indiana. But now we're seeing cool anomalies for the winter season across Iowa, Missouri, and Illinois as well. So kind of a mixed bag, a mixed season. I always say it's pretty interesting when we get these extremes, which is really the world we're living in today, where you can get a warm January and a very cold February. You divide by 2, take the average, divide by 2, or take the sum and divide by 2 to get the average, and you have an average winter. But this is not an average winter. Very warm in January, very, very cold in February, a land of extremes. Looking at the last 30 days in terms of precip, now I mentioned we've had a much more active pattern now over the last 30 days. So much of the southern extent of the Midwest here has picked up decent amount of precipitation, and a lot of this in the frozen variety as well. But anywhere where you see the yellow shading to the beige and the orange and even the reds, we're looking at more than 2 inches of liquid equivalent precipitation. Some of the drier areas have been across the upper Midwest, parts of the UP of Michigan, really kind of a snow deficit until really recently there in the UP of Michigan, and then across northern Ohio as well. So we have some lingering dry conditions underneath that snowpack because all of the moisture right now is locked above the surface in that snow and that ice pack. Looking at the last 7, 30, and 60 days compared to average, again, kind of a mixed bag, very dry across the upper Midwest, much of Iowa, Wisconsin over the last week, 30 days as well. And then also just the last 30 days across northern Ohio here closer to home, where we've had a lot of places pick up less than 50% of average over the last 30 days. And even over the last 60 days, many areas below 70% of average. So while all that moisture is locked above surface, what's going to really, really help us out is if we have a slow melt season that we're able to trickle in that water to the soil surface and not just run off into our streams. So that's kind of what we're looking forward to. We need a nice melt season here to get some of that moisture into our dry soils across Northwest Ohio. Much of the state is doing okay, as you'll see in a second, but some areas could use that. So speaking of, let's look at the current soil moisture and some departures from average here. Close to home, as you know, we've had lingering dry conditions across northern Indiana, stretching into Northwest Ohio, as I've mentioned. So we still are running about 20 to 30 percentile in terms of the soil moisture sitting there underneath that snow surface. Very dry, much drier conditions still lingering over parts of Iowa and parts of the Dakotas from last year's drought conditions. And then again, also even greater concern in the Four Corners region and out into the southwestern US. Another product we like to look at, this is looking at the top 40 centimeters of our soil moisture. You can see big deficits across the Dakotas and in Nebraska, down into northern Kansas as well, stretching through Iowa, southern Minnesota, Wisconsin, and then big deficits in our soil indicated by this satellite product here across northern Indiana, northern Ohio, and southeast Michigan. So really, I think, this upcoming spring and summer season are going to be largely dictated by two things. One, how does the melt proceed over the next few weeks? And then how much more moisture do we get from this active season, this active pattern that we're in, that we're likely to continue throughout our spring season? So those will be the questions here locally that help dictate our spring and then eventually our summer growing season conditions. This is in the bottom left, this is the moisture change just from the end of November. So overall, this has been a drier than average winter so far, and some of those soil moisture anomalies have increased across much of Ohio, Indiana, and Illinois, stretching back into Missouri as well. So something to keep an eye on as we proceed now over the last part of winter and into our spring condition. So getting to that snow depth out there and that snowpack. As of yesterday, 73% of the lower 48 has snow cover. I mentioned the little hole up here in the Dakotas. Funny thing, there is more snow on the ground in Austin, Texas than there is in Aberdeen. So pretty interesting to get that kind of setup, but plenty of snow across much of the country. 73% again, of the lower 48 has snow cover. This is the highest value, the greatest value since 2011, which was around 71%. So it's been a while since we've had this much snow cover across the country. And then when we look at the snow water equivalent, how much moisture is trapped in that soil above in that snowpack above the surface, it's pretty high. Here locally in Ohio, these purple shadings, we're getting between 2 and 4 inches of liquid equivalent stored in that snowpack. Even greater as we go back into northern Illinois, southern Wisconsin, and eastern Iowa here, where they're getting close to, up close to 5 to 6 inches perhaps in that soil moisture. So again, how does the melt season proceed? Will this be beneficial to our soils? That is something that we'll have to watch now over the next 4 weeks, and we'll have an update on that with next month's outlook. So potential to help our dry soils across Northwest Ohio, but it really will have to wait and see. Now, another thing to consider are stream flows across much of the Great Plains and the upper Midwest. Of course, our gauges are iced in, so we don't get a lot of readings there. You see a lot of red and orange dots across Indiana, Ohio, even stretching up into the Northeast. This is really a combination of three things, really. One is the lack of rainfall, the lack of precip in general that we've seen for the wintertime. Two, most of it's been frozen lately. So again, that moisture is above the surface. And three, some of these rivers and streams with the very cold temperatures that we have are even freezing over here locally. So there's some issues with the gauges there. But overall, again, we have to wait and see how we get that moisture from what's currently sitting on top of the soil. So this is the current U.S. Drought Monitor outlook that was released yesterday for conditions through this past Tuesday. Much of the western half of the country is in drought conditions, with some really extreme to exceptional drought back in the southwest portions of the country, California, Nevada, Utah, Arizona, etc. We had a pretty strong drought in Iowa last year, especially in the Northwest. So that's continuing here. We still have a few counties there in the extreme drought stretching across the upper Midwest. Here a little bit closer to home, again, we've had those dry conditions from central Illinois stretching northeast through northern Indiana, Ohio, and southeastern Michigan. We've had a little bit of recent expansion of the D0 conditions. This was really, in the wintertime, drought conditions don't seem like something that we really need to be concerned about. We don't see a lot of those visible impacts to crops and our ponds and things like that. But this is just really indicating that the precipitation has been abnormally dry, and it's been that way for quite a while. So again, this is the area from a drought perspective that I'm most concerned about in Ohio right now, with this abnormally dry conditions across the Northwest counties. Again, looking at the last 2 months, we've seen that little bit of expansion southward here of what we call D0 or abnormally dry conditions, with some improvements across northern Illinois, Indiana, and stretching back through Missouri and Kansas as well. The seasonal outlook on drought, again, with our La Nina conditions in an active season, it's likely that we'll remove any drought here around the region or potential for drought. But this has to be monitored. We have to see how our spring conditions unfold over the next couple of months. We do expect the drought conditions to really persist out west. So this upcoming growing season for the Dakotas down through Nebraska and even western Kansas could be a little bit concerning for those folks out there. And certainly there may be some impacts on the markets depending on how the spring season and the growing season pan out in terms of drought conditions in that part of the world. So I would say that, from a market standpoint, this is something to watch as we head into 2021. How extensive does the drought become? How intense is the drought? And what impacts that might have on commodities out there across the country. So now turning our attention to the forecast, looking at the week ahead. So we've had, another pretty big system across the eastern U.S. kind of moving offshore today. Some lingering snow showers across the Ohio Valley and the Great Lakes, but high pressure really moving in through the heart of the country and keeping those cold conditions around for the next couple of days, certainly through tomorrow. And then we see signs of a warm up. We see signs of a pretty decent thaw for much of the southern states, and then starting to get a little bit warmer from the Central Plains through the Ohio Valley region, with a warm front approaching the region for Saturday. Sunday, we will have another system moving through, but this time it does look like it's going to take a more northwesterly track relative to the state of Ohio. That will bring some snow into the Chicago area, northern Illinois, and eastern Iowa, but rain for folks from Missouri through central Indiana and into Ohio. We really think it'll be a rain-snow mix across the state as we head through Sunday night, Monday, but pretty light as well. But then as we head into next week, I think there's some reinforcing air masses. We're reinforcing shots of relatively mild air. And by mild, I mean normal. Normal highs this time of year in Ohio, for instance, are in the upper 30s to mid 40s for next week. And so just getting to the mid 40s gets us to where we should be this time of the year. I know it doesn't seem like it, but we're well past the bottom, the pit of our winter per se, about the second, third week of January. So things really are starting to ramp up in terms of getting temperatures warmed up a bit. So we think that's going to persist. There could be an opportunities for folks from Missouri through Iowa or Ohio to really get up into perhaps the 50s, low 50s in some locations by the middle of next week. Now that'll drive a pretty quick melt, but certainly melt conditions for a lot of us will be underway next week. We're not looking at a lot of heavy precipitation this week, generally a quarter to half an inch across the Ohio Valley, much of the Midwest as well. So that's the forecast for the next 7 days. Now we start to turn our attention to a little bit extended outlook. Many of you are probably itching, right? Waiting for that snow to melt, get out there and start the spring field work. The 8 to 14 day outlook, this extends us through about the 4th of March here. This is from the Climate Prediction Center. Looks like much of the Eastern Corn Belt and Great Lakes region have an elevated probability of higher or warmer than average conditions. We're really seeing a pattern switch underway, a little warm up for the East, a cool down across the Western states with close to average there across much of the central US. Again, with this active system that active pattern that we've switched to, we do expect that active pattern to continue throughout the rest of February and into the 1st of March. With warming conditions, that's not necessarily going to mean frozen precip. So I think we're going to have to watch and see if we get any heavier precip in here that could cause, a rapid melt and some flooding issues. That's not what we want to see, but certainly I think it's on the table. It's on the table to watch, and we're just going to have to be mindful about that over the next couple of weeks. Now, on last month's outlook, I talked a lot about La Nina, what it means. Essentially, we're changing the jet stream. It becomes very active, and it's a wet pattern for the Ohio Valley. And I think it took a little while. Every year is a little bit different. But once we got into February, things really switched into this much more active pattern across the Ohio Valley. So wet in the Ohio Valley, especially through February. And I think that's really going to continue as you see in these outlooks, unfortunately, for our spring outlook here, okay? We do expect the La Nina conditions to remain into the beginning part of our Northern Hemisphere spring. This graph is just showing the probability is greater for a La Nina versus either climatology, what we typically expect, or any other type of El Nino event or things like that. But we will then transition to what we call neutral conditions by the time we get into mid to late spring. What does that mean? Translating it, as my colleague used to say to plain penguin, basically it means much of the pattern that we've seen is likely to continue through much of the springtime. I think our temperatures will warm, and it's likely we're gonna get a little bit above average. Typically with La Nina conditions in March, we see a little bit warmer than average conditions. The probability is certainly on that side of things, but again, active system means a pretty elevated probability of above average precip for the month of March, and also March through May, really keeping that above average or higher probability of above normal precip anchored across much of the Ohio Valley and the Great Lakes region. So it could be a slow to get started kind of season with some challenges to any early planting season. Of course, we'll have a more up-to-date look at this in a month's time from now, but that's the way we see it here sitting here in the middle part of February. And then heading into the growing season, overall looking at the this isn't the right graph here on the right, but we do expect warmer than average conditions. A lot of that's just our overall trends. Warmer nights, a lot more nights in the 60s and 70s or 70s than we saw in the past. And this isn't the correct outlook here on the right-hand side. I forgot to delete this one. The right one is behind it. But we should see an easing of those greater probabilities. So I went into a little bit more of this in last month's outlook, but what we've seen in terms of the long-term changes is that despite wet springs and wet falls and even wet summers overall, when we get into that central portion of the heart of the growing season in July and August, those precipitation trends aren't as strong. And certainly the outlook this year does relax as we head toward the July and August timeframe. Okay, so I'll wrap up like I did last time, a quick international look in for folks that are interested in things that are happening elsewhere and the weather impacts on commodities, focusing primarily on South America here. Rain has continued in northern parts of Argentina, but there are some parts that have been fairly dry. The northern portion of Brazil as well has seen plenty of shower activity recently. And this is the latest crop and weather bulletin, just kind of highlighting Argentina and South America a little bit. Rain did continue across the northern farming areas in Argentina, but drier conditions redeveloped over the summer grain and oilseed areas of central Argentina. And you can see that right here on the map, just looking at these precipitation amounts that are quite low here across this portion of the country. So temperatures have been a bit cool, which has helped mitigate a little bit of the dry conditions. But generally those first crop soybeans are filling to maturity, but there's no early signs of early harvest taking place with these conditions right now. Over in Brazil, beneficial rain really brought back to the northern soybean region and the cotton area regions here. As you can see, indicated by all the green area here, plenty of moisture available. Really kind of late, there was a bit of a dry spell late for this recent rainfall, a little late for the maturing soybeans and corn there, but it is pretty timely for the emergence of the second crop corn and cotton. So just getting some timely rains in this portion of the world as well, even though the harvest was a bit behind the season. So with that, I'll go ahead and stop the presented material. There may be some questions that we'll take right now before we turn it over to Ben to talk about our outlook. So with that, thank you very much. And I will turn this back over to Kelly. Thank you.
Thank you, Aaron. I don't see any questions as of yet. Give people a moment to.
Yeah, I just saw the chat going, but I didn't have a chance to look, so I wanted to make sure.
I appreciate that. Yeah. Awesome. No, just actual chatting's been going on.
Yeah, good.
All right. Well, I'm going to go ahead and introduce Ben. So why don't Ben get your slides ready? Of course, if you still have questions for Aaron, put them in the chat or the Q&A, and we will address those. All right, so Ben has given me permission to do an abbreviated version of his intro bio. So I'm going to just update those who are not aware that Ben is now a senior research associate with the University of Missouri with MU Extension and the Food and Agricultural Policy Research Institute. And we all know that prior to joining MISU, he was here with us in AEDE. So Ben, take it away.
Yeah, thanks, Kelly. Appreciate it. It's exciting to be with you all today. This morning, I always enjoy joining my friend and colleague Aaron Wilson on these calls, and he always does a fantastic job. So I'm going to do a little bit of the grain marketing side. Certainly, a lot of what we face in grain markets also is impacted by weather, and certainly tied into Aaron's last bullet there of South American weather and harvest and planting at the moment as well. So this is a picture from my family's cattle operation that we just had. This probably taken a week ago. As Aaron mentioned, we've had quite a bit of snow and quite a bit of cold weather here in Missouri, and it's made calving season a little bit of a challenge this year. So, and then I threw my picture up there just in case you all forgot what I looked like. But again, it's great to be with you. Similar to kind of January's update, we're going to touch briefly on the fundamentals of grain markets, but I actually want to spend the majority of this webinar talking more about the macro economy. And then, so I'm a researcher here at the Food and Ag Policy Research Institute at the University of Missouri, which if you're not familiar with Februrary, we provide a set of baseline expectations for Congress in several policy scenarios that we run throughout the year. And so we are finishing up our baseline right now, and we will be presenting that to Congress virtually in March, and then our big ag outlook here at the University of Missouri the middle of March. So you all are going to get a sneak peek of some of our early estimates so far this year for some of our major commodities. But in the next one that Aaron and I do in March, I plan to focus more on grain marketing strategies. This one, like I said, will be more kind of big picture outlook and macroeconomy. So if I can get my slides to go real quick. In case you forgot what happened in 2020, that certainly set the lens for 2021. We had a phase one trade agreement a little over a year ago, that created some renewed optimism in the grain markets. We had a pandemic that hit that changed everything from how we eat to how we drive, where we eat, the general economy with millions of people out of work, and then records amounts of federal spending and increases in the federal budget. So the reason I bring this up is because we're going to spend quite a little bit of time on how this all fits into the economic outlook. But then U.S. crops towards the end of the year came in much smaller than anticipated, partially due to the drought Aaron talked about, and then the derecho that hit Iowa August 10th. So certainly some supply reductions, and then we saw China go on a buying spree towards the end of the year, really increasing their stockpiles of grain and providing us an opportunity to export grain. So if I showed most farmer groups these two graphs, they would probably pretty easily figure out what these graphs were. The only question would be, without looking at the price scale, which graph is which commodity. And certainly if we look at these are the most active corn and soybean contracts that we've experienced. And certainly we've seen rapid increases in grain markets over the last 5 to 6 months. The one thing I want to point out is if we add that August 10th ratio right there, that was roughly about the start of the time where we saw futures contracts really start to increase. This was, again, as I mentioned on my previous slide, a combination of reduced supply and increased purchases by the Chinese, increasing our demand. However, the thing that I want to point out for those of you that watch the market, many people would argue that these signals were there before August 10th. That we felt like China had increased their early season purchases enough to cause opportunities later in the year. The fundamentals were certainly there, and certainly the drought was causing some people to think that this crop was going to be much smaller than what we thought. But in the grain market, sometimes it just takes one event to push us to change our lens of how we look at markets. And I think that's what the August 10th ratio did, as it changed the lens and how we looked at grain markets. Prior to that, everybody was still looking at these markets in the realm of somewhere around 17, 18 billion bushels of corn supply and 700 million bushels of carry out in soybeans. After this August 10th ratio, people started to realize, hey, these fundamentals look more supportive to commodity markets than what we thought. And as a result, we're also seeing some inflationary pressure, a little bit of money moving into the grain sector that's causing prices to increase as well. So I want to start out here. And again, I've showed you this last month because January represents the end of a marketing year in all respects. And so we were finishing up January, finished up the 2019-2020 marketing year. And it also represented what is supposed to be our final estimates for the 2020 crop. Now, we have seen USDA go back and revise those. They do hold they do refrain the opportunity to do that. And so certainly we have seen them make adjustments in the past, but it's really the last two columns that I want to draw your attention towards. We get the first estimate for the crop in May, and then August was right there before the derecho, and then February is where we're at today. And the last two columns show our changes in two periods, May to August, and then from August to today. And if you look at that, probably the biggest number that I can point out, and again, is just show how much of a reduction we had in the corn crop. We reduced the U.S. corn crop about 1.8 billion bushels. If you add both the reduction from the drought from May to August, and then the changes that we've seen since August to February in reduced yield and acres. Ending stocks were pulled down, 1.7 million bushels, 1.8 million bushels as well. But even during the midst of this, with higher prices, we have continued to see our export markets remain strong. And I think that is very positive when we start to ask the question, is this demand real or not? The fact that these export markets have continued to make sales during increasing prices is very promising. On the soybean side, the interesting thing about soybeans was USDA currently is only 10 million bushels off from where they were expecting and estimating all the way back in May. Now they got there kind of the wrong way with a different combination of yields and acres, but certainly with the changes we've seen in the balance sheet, their ending number came out very close to where their beginning number of 4.1 billion bushels was. But again, it's that export number, even in the face of rising prices, that continues to really support soybean prices when we get that kind of demand in rising price environments. Usually prices go up and we start rationing demand, and we haven't seen that yet in the export markets for both corn and soybeans. Now I'm going to show you some things on the corn side that caused me some concern, but I think this is overall a positive picture if we're looking at supporting these prices. At the same point, global grain stocks for corn and soybeans have decreased. So what I'm showing you here is the production and consumption by marketing year. Anytime the yellow bar is bigger than the black bar, that is when consumption outstripped production and we reduced our ending stocks. And so you can see in 2020, well, at least for the last 2 years, we've drawn down global stocks of corn and soybeans, but we continue to increase our wheat stocks. Production continues to outstrip wheat consumption. However, that gap is closing thanks to high corn prices, increasing wheat feeding. So certainly something that when I look at USDA's numbers that they released this morning at the USD Outlook Forum, I think they're a little conservative on wheat feeding, just from the standpoint that we continue to see high corn prices. And for us out here in the Western Corn Belt, when corn price becomes high relative to wheat price, we do increase wheat in our feed rations. That's not something we see a lot in Ohio, but we certainly see it quite a bit in Kansas and Nebraska, even Western Missouri to some extent. So with that being said, I want to touch on a couple of macro outlook topics. For first, I'll start off and show you the U.S. dollar. So the U.S. dollar has continued to weaken. And if you look there, starting in 2021, certainly we've been on a downward trend. This is a couple of reasons. One, we've seen strength in the euro, and so that tends to put downward pressure on the U.S. dollar as the euro strengthens. The other component of this is we continue to add dollars into the U.S. economy, whether that's through federal stimulus or whether that's through the Federal Reserve buying assets on their balance sheet. They tend to buy a lot of mortgage-backed securities for their balance sheet. All those things continue to push down the U.S. dollar. And the chart that you see down there in the bottom left within the bigger chart just shows you the last couple of days. Actually, I think it's the last 5 days of U.S. dollar movements. It started to strengthen a couple of days ago when there was concern about the stimulus package actually getting passed. Now that it looks like the stimulus package is on its way to being implemented, the U.S. dollar has continued to fall, and we heard Janet Yellen again, support her claims that we need federal stimulus to the economy to support the economy, and that the U.S. debt can grow to accommodate that. Now, certainly there are downsides to increasing the U.S. debt, but her argument is without the stimulus, we will never retain the levels of employment that we saw prior to the pandemic, with roughly 6.5% employment rate. That includes a lot of people that left the labor force. And so to even get back to where we were employment-wise before the pandemic, we're going to have people come back into the labor force that have currently exited. So certainly some, I think maybe some artificial claims a little bit of we need the stimulus to get back to employment. Part of the issue here is just not having enough people in the labor pool at the moment to even reach those numbers. So certainly that's what they're trying to work towards. If we look at the commodity sector, which I like this Thomson Reuters equally weighted commodity index, these are the 17 commodities that are part of the index. It favors the ag sector heavily, but includes energy and metals. And when we look at what that index has done, it is negatively related to the U.S. dollar. So as the U.S. dollar goes down, the commodity sector usually sees support, and that's probably not surprising given that there's a whole bunch of reasons that you might want to see a strong dollar. But if you're selling products internationally, a weak dollar helps you sell your product. And as a result, we've seen interest into the commodity sector pushing us out of that channel. Certainly, you can see where the pandemic hit here in early 2020, but then we have quickly recovered from that and even pushed out of that channel to the positive side. looking at managed money, this is something that I think continues to hold commodity prices, provide downside risk to commodity markets. This money continues to keep flowing into the commodity sector, which, as people buy futures and options within, these four commodities, corn, soybeans, Chicago hard and soft red winter wheat, and then Kansas City hard red winter wheat. As people buy those, it does push up the prices, but it does expose us to downside risk if they ever started selling out. And so certainly we're at fresh 8-year highs in managed money, or the amount of money that people are investing that aren't involved in agriculture. So these people tend to be quick into the market and quick out. So if signals turn on a dime, this would cause some selling pressure, and certainly something that we've continued to watch to see if these people started selling out. A quick COVID update: cases have really started to drop off, which is a very pleasant sight to see. We had 58,000 cases on Tuesday, which is still way too many, but that's way down from where we were on January 8th, when we were almost at 315,000 cases a day. The 7-year average continues to fall. It's down about 86% over that same time period. However, the deaths have continued to chop sideways, even though they are on a slight downtrend. They have continued to chop sideways, but we've seen some much improved numbers the last couple of days, and I think this is as of the 17th. So even the last couple of days have provided some better numbers than what these even show. And so still way too many deaths, way too many cases, but moving in the right direction. Hopefully we can start recovering the economy and getting things back in place. I want to talk about this real quick. Certainly, our farm economy is nowhere where it was, or is today, where it was in the 1980s. Certainly, you hear a lot of people within the last year kind of compare what 2020 started out looking like to the 1980s farm financial crisis. To be fully disclosed here, I did not live through the 1980s. I was a product of the long shadow of the recovery in the 1990s, but I did not live through the 80s, but I heard a lot about it, and I've studied a lot about it. And, there's a lot of the same rhetoric now, and a lot of the same signals now that we saw in the 1970s, which, brings me pause for concern, maybe. Things like, new demand, right? You're hearing a lot of people talk about this new demand from China. Very similar language to the new demand we heard about the Soviet Union back in the 1970s, when they came in, the Great Russia grain robbery in the early 70s, when they bought a bunch of wheat. And we all of a sudden thought we had brand new demand, and it just never did materialize. The question now is, everybody believes China has new demand. Does it continue to materialize, and does it continue to stay? I do think China's demand it feels more real now than what it has in the past. Certainly, the dry crop that Ukraine and Western Russia and other Black Sea countries had last year has certainly helped us. But then there's been other things that have helped Chinese demand seem more real. Their reduction of food scraps in their feed rations have created higher demand for soybean meal and corn and stuff like that, much more than anybody anticipated. So the demand does seem more realistic now than what it did. But again, I remind you that we had the same rhetoric about the USSR way back in the 70s. Same way we heard Jimmy Carter and Earl Butz, they talked a lot about needing to increase supply to meet this new demand. Earl Butz's famous line was, farmers are going to be out there planting fence row to fence row. Under the previous administration, we heard President Trump talk about this new demand is going to create a need for farmers to get bigger tractors because they're going to be farming so much. We also have record low interest rates now, similar to what we did in the 70s. So it's giving the impression that you can borrow money cheap, and if inflation creates the value of assets to increase more than what you're borrowing, it creates this falsehood of the real value of asset appreciation, right? Meaning that as long as interest rates stay low, we can support those asset values. But if interest rates ever go higher, certainly that is a concern for us, especially in this time of increasing land value. So the only thing in this picture that we don't see now that we saw back in the 1970s is record high inflation at 12% year over year. And certainly we haven't seen that. But I want to point out that the last couple of weeks, the yield curve for 10-year bonds has increased at a rapid rate, fresh 1-year highs and increasing very fast. And so the Federal Reserve is going to do everything they can to control that yield curve from getting too steep. And again, the yield curve is the difference between the 10-year treasuries and the 3-year treasuries. They can only control short-term interest rates, but they will use the Federal Reserve Bank to buy those assets to help control long-term securities. And so certainly, I think we're entering into a period where we're maybe starting to look at some strong inflationary signals that if inflation gets out of hand from us too quick, it will force the Federal Reserve to increase interest rates to counter that record high inflation. So certainly something that I think is concerning, even though our debt to asset ratios aren't anywhere near the 22% peak that they were in the 1980s. They have been increasing, and at least our forecast at Februrary is for them to continue to increase over the next couple of years. I told you I would mention a little bit about federal stimulus. In the last year, we spent $4 trillion in 7 pieces of legislation under President Trump related to COVID relief. We've still got about $1 trillion of that still left to spend, somewhere around 900 billion. Actually, it's not quite $1 trillion. Still to spend from previous stimulus bills. Now, some of that's allocated money that just hasn't been used yet. But it still is unspent, and Congress seems to be and appears to be on track to pass another almost $2 trillion under President Biden. So when we look at our federal deficit, the analysis that you see there in the top right hand of your screen, that shows a federal deficit somewhere around $2 trillion for 2021. That does not take into account, the extra 1.9 trillion that this stimulus package would result in. So we're looking at another year of really large federal deficits, continuing to grow our national debt. Congress does not seem to be worried about national debt until interest rates start to increase and debt service becomes expensive. And so certainly if we start to see these inflationary signals from that yield curve getting too steep and the Federal Reserve is forced to raise interest rates, you could be looking at the U.S. Congress trying to control some of the spending and debt levels that we have. I told you I would mention about the Federal Reserve. Their expectation is to keep interest rates low in the meantime, and keep in mind we're at a zero bound right now, which means that they cannot set their target rate any lower than where it's at right now on interest rates. But the Federal Reserve has continued to grow its balance sheet. Certainly, if you look all the way back in 2008, you see that blip. From 2008 between 2010, that was the Great Recession when we started this quantitative easing, and we've dwarfed that in the last year in terms of quantitative easing on the Federal Reserve's balance sheet. The interesting thing is when we look at managed money, and certainly there's 2 forms of managed money. There's M1 money supply, which is the most liquid. This is what's in our pockets and what we spend. Managed money is up 62% in the last year. That's probably not surprising given the level of stimulus packages that we've seen. The interesting thing is that M2 money, which includes savings and deposits, is only up 24%. So if you look at those 2 numbers alone, what that tells us is that M1 money supply has increased faster than M2 money. So people are not putting their money in savings accounts or long-term bonds or securities. What they're doing is they're hanging on to it, putting it in like a petty cash fund or a checking account, something like that. It's very liquid. But that third bullet point down there, the velocity of money, so how quickly a dollar moves throughout our economy, is the lowest since records begin in 1960. People just aren't spending the money. They have it in cash and sitting in their bank account, but they're just not spending it. This signals that people are holding money in case things get worse, or in case they get laid off from their job or unemployment or something like that. They're holding their money, but if things ever started to open back up to where we felt safe to spend again, we could see rapid expenditures really pushing up some of our prices and increasing inflation. So everything I have just told you right now. Let me just summarize and say we are not seeing inflation. That is the one difference between now and the 1970s, is we're not seeing the record high inflation. However, everything on the back end, all the fundamentals certainly point to we could enter into an environment very quickly where we see rapid inflation. And certainly I don't know how high. I don't think 12%, but somewhere between where we're at today of 2% and 12%. And keep in mind, for the last couple of years, the Federal Reserve has even struggled to get to 2% inflation. That's been their target, and they've even struggled to get there. So a couple of current issues around the world. Aaron touched on some of these, but I want to talk about the phase one purchases. I showed you China's import data last month. This time I'm going to show you U.S. export data to China. What the big graph there in the middle is showing is this is the phase one targets. The red line was what we needed to export to China every month to hit the phase one targets, and what I thought was possible. The black dotted line there is 2019 exports, and then the gray bars are what we actually export. So you can see that after the first 7 months of the year, with a cumulative shortfall of 43%, we came very close in all the back months in the last 5 months of the marketing year, coming very close to where I thought we could be and where we needed to be to hit those phase one targets. So if we look ahead to 2021, there is the potential to continue to increase trade to China, given that we feel like the first 7 months of the marketing year were slow due to COVID restrictions within the Chinese economy, also removing some of those non-tariff barriers that we saw on things like beef and infant baby formula for milk, some poultry. Those all products saw non-tariff barriers removed, allowing their entry into the country. And as a result, we saw some pretty impressive numbers on the back end. So the chart to the right shows that this was a record year of ag exports to China. Even though it started off slow, we did have a record year, just eclipsing out the 2012 highs just barely. Keep in mind, 2012, we had record high exports, but prices were also high. So it's not just the quantity, but also the value or the price of those exports that matters when you're looking at the total value. The big question here is how the Biden administration responds to the failure to meet those phase one trade targets. Here's the 4 categories mentioned under the phase one deal. The first category was agriculture, which, at least according to U.S. records, China only completed 82% of the expected purchases. Energy, they only completed 37% of the expected value, and manufactured goods, they only completed 57% of the expected target. So those are the 3 categories laid out in the deal. The 4th area is uncovered goods. This is everything else that wasn't covered under the trade pack. And so we expect it makes up some portion of the increased sales, but we don't know how much. And so therefore, on that chart there, what I'm showing you is total 2017 exports. And so if we were to increase, need an increase of about $12 billion in total in this category, we were well away from that. So the question becomes, now that China has not reached those targets either by Chinese standards or US standards, and I will point out that for agriculture, China came much more closer to reaching their targets looking at US export data than they did with their own import data. So their own data only showed that they reached 64% of their total commitments, where US export data shows that they reached 82%. And so US export data is much more supportive. But again, how does the Biden administration respond to that? The second thing that I think is important in China is we are starting to see an emergence of African swine fever again. I showed you, highlights and headlines last month when we looked at this. We've seen even more since then. So these are all just in the last couple of weeks. Hong Kong had to call 3,000 pigs after an African swine fever outbreak in their, part of the country, or part of the. I guess I don't really know if it was on the Chinese mainland side or if it was actually in what Hong Kong believes to be their land, or vice versa. But somewhere in that Hong Kong region, 3,000 pigs had to be, basically disposed of. So we have seen some liquidation, but not near the levels that we saw in 2018. I think the big concern right now is we're seeing many different mutations actually emerge. They're creating the need for additional vaccines and monitoring of this herd. But it has helped that their hog herd has become more commercialized, increasing biosecurity, very similar to the United States. We have a very commercial hog herd in the United States with strict biosecurity. standards, and it's I think it's a positive for everybody in the long run to see China move in that direction. The other thing that I think, not just African swine fever, but we're also seeing PED start to outbreak. And PED again is that disease that kills baby pigs. It doesn't necessarily affect the breeding herd, but it affects the calf or the piglet crop. And certainly we've started to see issues of PED start to emerge as well. So certainly nothing of great concern yet, but definitely starting to draw more attention. And I think it's something we'll have to keep an eye on over the next couple of days. China continues to crush soybean meal to feed that herd and that growing herd. And I showed you this slide last time, but in 2020, Chinese soybean crush exceeded 2 million metric tons 23 times in 2020. They'd only done it 5 times in the previous 4 years or 3 years, 2017, 2018, 2019. So they are increasing soybean crush very substantially. They are using a lot more of it than what many people expected, because I think we did not realize how big of a deal food rations were in their feed rations, or food scraps were in their feed rations. So something that has been supportive of soybean meal demand is that change in rations. High corn prices within China have continued to provide an incentive for China to import corn. And so the blue line there is Chinese interior corn price. The orange line is U.S. corn freight on board at the Gulf. And then the gray line is the cost of that grain once it hits mainland China. Now, that does not include the tariff, the 65% tariff, or a value-added tax. So, it could make it more competitive. But at least from what we're hearing, certainly corn continues to make economic sense to import it into the country at the moment. So what's the outlook for China just in general? Well, a couple of things that, just kind of in summary, I think keeping a watchful eye on PED and African swine fever as we've started to see more and more cases emerge is going to be important. Keeping track of that and understanding, how big of an issue or how wide of an outbreak we could be looking at is something I just can't answer right now. I don't know how big of an outbreak we're looking at, but certainly the trends are not in the direction we like to see them. Is China stockpiling their corn and soybeans or using it? It definitely appears to me that they're using their soybeans, that they are using every bushel of soybeans that they can get. They are not stockpiling those soybeans. However, it is starting to look like they are stockpiling corn. The amount of grain sorghum that they've imported, the amount of wheat that they've released from their strategic stocks, the imports that they've had from other countries certainly suggest that even though they have a gap between what they can produce and what they consume in terms of feed grains, they've met that with all these other feed grains that they've imported. So now that they continue to increase corn imports, and we saw 230 million bushels of corn sold to China within 1 week from the United States, our largest week ever of corn export sales to one customer. That was something that was very, very supportive of corn prices, and especially when they accompanied that with about a 70 million bushel of purchase of corn-based ethanol over the next 5 months. So now the timing of all this is rather interesting. Right about the time that those purchases happened, the U.S. sent a warship, a U.S. carrier, through the strait between Taiwan and mainland China. Now, we've done this before, but this was the first time that we've done it under President Biden. And that was Biden sending a message that he was going to pay close attention to Chinese relationships and their potential hostile takeover of Taiwan. U.S. has supported Taiwan independence, but it's something that those geopolitical relations and tensions continue to create some headwinds for the grain sector. But the timing of all of that was right before China announced 230 million bushels of corn exports and 70 million bushels of ethanol imports to China. Was also the same week President Biden was inaugurated. So the timing of all this is rather interesting and something that we'll have to watch as we go forward. Looking at South American production real quick, Aaron talked a lot about this, but we are looking at strong production out of South America. Certainly some nice increases in soybean production for both, so soybean production, but relatively stable for Argentina, and increases of about 7 million metric tons for Brazil. Now, certainly when Aaron showed you the weather outlook, we've continued to monitor some of the conditions in both the Mato Grosso region of Brazil and then even the north central region of Argentina. But private estimates are now coming and supporting some of these numbers as well. On the corn side, we've continued to watch Argentina's corn crop and how it finishes out and matures into a yielding product. But probably the biggest point I want to make on this chart is the increase in Brazilian corn production. Now, we've largely accredited that to the Safrinha corn crop, or the second crop corn that Aaron was talking about earlier. It is late getting in the ground. That will have, in some cases, impacts on yields. And so we're certainly a long way from knowing what that final Brazilian corn production will look like. If we look at South American weather real quick, and Aaron talked a lot about this, at least the part of Argentina that we've been watching for soybean production has showed some moisture that has helped fill out that soybean crop and support the estimates that we saw. And again, there's the soybean growing region, and then the deviation from the anomaly, the change from normal precipitation in that region. On the Brazilian side, it continues to be dry over their dominant soybean growing region. And Aaron talked a lot about this too, in terms of, they've got some moisture, but it seems to be too late for that early season soybean crop, but will provide some support to that second crop corn crop. When we look at Brazil's second crop corn, the graph on the left shows Brazilian futures for corn for July, which would be their harvest futures contract. They're well above in terms of reals per bushel compared to where we normally are. So my expectation is that whatever Brazilian producers can do to get the corn crop in, they will do it. Now, it has been slow so far because of the late harvest of the first crop soybeans, and that's what's represented in the graph to the right. It is behind, well behind where we normally are, to the tune of about 23%. But certainly, I believe with these prices, Brazilian producers will do whatever they can to get that crop in the ground. So looking at U.S. demand real quick, we finally saw a tick up in weekly finished motor gasoline. That's good news for ethanol consumers. Again, we see that finally a tick up to only 6% below. We've been hovering anywhere between 10 and 14% below every week of this marketing year so far. So a good week last week in finished motor gasoline demand. However, it didn't really transition into weekly ethanol production. We usually do see about a 1 to 2 week lag in ethanol production. So given that increase in gasoline, we would expect an increase in ethanol production here in the next week or two. Looking at our expectations for both annual gasoline consumption and then annual ethanol consumption, we do expect a recovery, but nothing in 20. This is all based on a corn marketing year. So we're in the 2021-2022 marketing year right now. We'll be until August. And so you can see that we've recovered and rebounded, or excuse me, this is for next marketing year. So the marketing year, they'll start in August and go to September and then go to August of 2022. You can see that we're expecting a rebound all the way up to 138 billion gallons of gasoline consumption next marketing year, and an increase of almost up to 14 billion gallons of corn ethanol production next marketing year, but nothing where we were, still not getting back to where we were prior to the pandemic. And this kind of just drives home my point. So here is our expectations for ethanol consumption over the next 6 years, basically. You can see where we were all the way in 2005, and I've purposely set this graph to where the axis on the right, which represents ethanol, is exactly 10% of the axis on the left, which is billion gallons of gasoline. So anywhere where the black line and the gold line are over the top of each other, that basically means that everybody's driving on 10% ethanol. Where the black line exceeds the gold line, that means that we start seeing more E15 and E85 enter into our gas stream. But even if you look at those lines, at least from our projections here at Februrary, we never get back to the same level, the amount of ethanol production, even with E15 and E85 increases in use. We do not get back to the level that we were in ethanol production before the pandemic. Looking at corn demand real quick, this is corn export commitment. So this is everything that's left the country and shipped, and those of outstanding sales. And you can see that we've had a very strong year for export sales, but USDA's target was very aggressive at 2.6 billion bushels in the red line there at the top. The blue line there certainly is supportive and very encouraging for the pace that we've seen. Currently, export sales, at least on a season average pace, are 670 million bushels more than USDA's current target, but only 34% of what we have sold has actually shipped. So we've got a long way to go. Not only do we need, so what this chart is showing you is that not only do we need more people to continue to buy, because our commitments do not reach what USDA is currently expecting for final year exports. So we need people to continue to buy even with these high prices. But even for what we've already sold, only 34% of it has shipped. And we expect with some of these higher prices, some folks will either cancel sales due to rationing demand, or they'll look at places where they can get it a little bit cheaper. And so we have seen some cancellations in the last couple of weeks of corn exports, but definitely something to keep a concern on. On the soybean export side, we continue to see excellent soybean numbers. And in fact, I would actually say that USDA probably should think about increasing their export target because we've seen export sales be very strong throughout the year to China and other places around the world, but especially the recovery in China. We have about 11 million metric tons of outstanding sales left to send out the door. So the majority of what we've sold is actually already left and is there. In fact, I think it's like 83% of what we've sold on the soybean balance sheet has already left the country. So we've already delivered that. And so, the soybean export picture looks very promising, very, very strong. The problem with that is we don't have a lot of soybeans to give anymore. Our balance sheet on soybeans is getting very tight. And so we expect to start seeing it in the domestic numbers. If we continue to export soybeans like what we've seen, we expect the higher prices to ration domestic demand. However, the latest soybean crush report that came out earlier this week showed the second largest soybean crush number we've seen on record, 185, almost 185 million bushels of soybeans crushed in the month of January. That's the second largest month, only behind October of last year. That beat our previous January record of about 8 million bushels, almost 8 million bushels. And keep in mind, the previous January record was set a year ago during the strong soybean crush year we saw in 2019 and 2020. But even with these expectations, currently we're on pace to exceed USDA or year over year soybean crush estimates by 50 million bushels. However, USDA has only got an additional 35 million bushels in their balance sheet. So that's telling me that they're even expecting domestic demand to decline a little bit. But the point I'll make here is if we continue to export at the pace we are and all the commitments that we have in export markets, and our domestic crush continues because of high prices for soybean meal, that's going to start to increase domestic imports. So U.S. imports of soybeans from places like South America. This is something that they did to us this last year, where they actually imported some U.S. soybeans because they ran out in the back end of their marketing year. I think we could enter in a scenario where we have to import soybeans on the back end of our marketing year to fill our domestic needs. So if we look at acreage real quick, again, these are Februrary's estimates that we'll report out here in the next couple of weeks. We're at 91.7 million acres for corn and 90 million acres for soybeans. USDA yesterday was at 92 million acres for corn and 90 million acres for soybeans. So almost the same and the same amount of total acres between corn and soybeans. Wheat up just slightly on winter wheat acreage increases, and then upland cotton just slightly down. Now, you're probably looking at that and saying, well, how can we go up in all four of those crops, basically cotton, if we hold cotton the same? How can we go up in acreage for all four of those crops? Well, the answer to that is I'm expecting a much smaller prevent plant, and that's what's represented in the graph to the right. Instead of 10 million acres of prevent plant, I'm expecting a more normal 3.5 million acres of prevent plant. You look at those totals, and total acreage is up about 1 million acres year over year. Now we have seen some reduction in CRP contracts. CRP contracts are down 500,000 to 1 million in CRP acreage. And part of that's policy driven. The terms for CRP acres are not near as lucrative as what they were. And so people aren't re-enrolling in CRP due to the lower contracts. And Aaron talked a lot about the snowpack and the cold weather we've had here in the Western Corn Belt. I just want to talk about what this could mean for wheat. I did study at Kansas State, and so we spent a lot of time talking about wheat, winter kill, and the ability to withstand some harsh conditions. The thing I always took away from all those classes is you never really know. And anybody that tells you they know how much of the winter wheat crop was killed due to winter kill really doesn't know either, because that wheat it all looks the same now and will look all the same for a couple more weeks or months until it starts to come alive, and then we can start telling what died and what didn't. On a textbook definition, about 30% of the U.S. winter wheat crop was in pretty significant risk of winter kill. You see the 22% there in western Kansas of the winter wheat crop that is grown there. The graph to the right shows the snowfall depth that Aaron showed earlier, and you can see that area did not have near as much snow as what they normally do. In fact, most of that area was looking at a quarter to a half inch of snow when these record low temperatures started to hit. And certainly the lack of snowfall with the record low temperatures is certainly at least a textbook reason for winter kill. However, wheat tends to surprise, and like I said, we never really know until the wheat starts to come out of dormancy. So we'll have to see, and I think that's what's putting downward pressure on wheat prices the last couple of days. Is there was the initial spike of the cold weather, suggesting that all this wheat had been killed off, and now people are realizing, hey, it doesn't look that bad. Maybe it'll come out of it. So the prices are coming back down on the increased production, thought. But again, we'll have to wait a couple more weeks before we see that. So on the soybean balance sheet, here's our numbers for 2021, 22. In that far column, again, we're expecting 90.3 million acres of planted soybeans, a trend yield of 50.3 bushels to the acre. You get down to the supply numbers at the bottom, and a production number that is 344 million bushels higher than where we were a year ago. But with the low beginning stocks, the very tight beginning stocks that we bring in, even with the 344 million bushels of increased production, our total supply is even down from last year. And again, that's just signaling how tight we are, record tightness on soybean stocks. I saw USDA's projections this morning right before we got on, and they're expecting a stocks to use ratio next year of about 3.2, 3.3. And so we're a little tighter than they are. They've got some assumptions in there about yield, and we just have a trend line yield in there. On the demand side, you can look at my numbers that you see, in terms of what I'm expecting for exports and crush. We've got a little less robust export number in our estimates. Part of that is due to a large increase, an expected increase in South American exports next year on increased acreage. And so we've got a lower export number for the U.S., but still that gets us to a 3.8 stocks to use ratio. And our farm cash price is $10.55. Now, yesterday, Seth Meyer, chief economist at USDA, announced that their projection for 2021, 2022 soybean prices was $11.25, so 10 cents higher than what we are this year, or what they're expecting this year, and certainly supportive of higher prices throughout the remainder of this year to get to those prices. If we look at USDA prices in the past in the yellow, where Februrary is in the blue, and then the November futures contract, so the first dot you see there is November of 2021 futures, and then the second dot is November 2022 futures. Certainly futures prices with an average basis would support USDA's estimate of 11.25 much more than our estimate of 10.55. So just kind of a point out there that with about a 60% normal basis, 65% normal basis, futures prices minus that normal basis gets you much closer to where USDA is than we are. But if you look at the corn side, Again, we're expecting almost 92 million acres of planted corn area. I do expect the actual farmer survey that comes out at the end of March to be much higher than that, to be over aggressive, and then we find our actual planted area to be a little bit lower. But I think we'll be over optimistic there at the beginning of March. Even with the reduced beginning stocks, or excuse me, same thing on soybeans, with the increase in production of almost 750 million bushels, the lower beginning stocks that start the marketing year creates an environment where we only see total supply for next year increase 341 million bushels, so year over year. On the demand side, we do have a return to food, seed, and industry, which includes ethanol. So almost all of that is made up for an increase in ethanol that I pointed out in my earlier charts. Exports, we've got a lower export target next year. We'll have to continue to watch how Chinese policy emerges with their tariff rate quotas and what they charge as a tax on corn imported into the country. So something to watch there. But stocks to use ratio that's much more comfortable, but still snug at 11.6%. And we've got a farm cash price of 410. USDA yesterday came out with their cash price of 420. If you look at the same thing here on corn as what we did on soybeans, a futures price right now of almost 460 for the November contract, minus an average basis of 40 cents, 50 cents, gets you pretty close to where we're at in USDA. So no real big squabbles between USDA's numbers and Februrary's numbers on the corn side. I'm going to throw wheat in here just real quick. I'm not going to spend a lot of time talking about it. Certainly these are in your slide decks that you can access on the website. But probably the biggest thing I think for wheat is you see the reduction in ending stocks of wheat, and I think that's a continued good sign. We've continued to reduce acreage until this year of total wheat acres, and as a result, that's helped us wind down some of those really burdensome high stocks. I think with increased feeding due to high corn prices, that continues to reduce ending stocks of wheat even further. So farm cash price of 516 in there for the wheat side of the equation. So key takeaways from today on the macroeconomy side, the dollar seems to have stabilized. It's been weakening, but we've been chopping sideways for a little bit, a couple of weeks now. And so certainly that's good to see the dollar stabilize a little bit, but could come under renewed selling pressure or downward pressure with a large stimulus package on top of it, putting more dollars into the economy floating around, circulating. COVID cases are dropping with a slight recovery in COVID deaths. That's a good thing for the general economy. The large amounts of M1 money supply that people are holding and not spending due to the low velocity of money, plus not the increase or the corresponding increase in M2 money supply, which includes savings. Definitely signals that there's pent up demand, that if things, again, if these COVID cases and deaths continue to drop and we start removing restrictions, we could enter into a very robust demand situation for a lot of goods. We're an economy that likes stuff, and so that's certainly signaling that. International, some things to keep an eye out and watch for. Chinese ASF and PED cases are worth monitoring. Certainly the geopolitical tensions between the United States and China over Taiwan and Taiwan's independence. On the row crop side, corn, we finally started to see some strong improvements in gasoline demand, which is good. And I expect in the next week or two to see that corresponding increase in corn ethanol production. I am concerned that we might see a downward revision at some point due to corn exports. Certainly, the slow pace we've seen in actual exports so far is partially due to the strong exports of soybeans, just kind of clogging up those channels and preventing or not allowing us the opportunity to export corn because we've been exporting so much soybeans. But still, with the higher prices, the need to find more buyers to reach USDA's current target, and the slow pace of export inspections does raise caution to where we could see some rolls of current sales, some cancellations of current sales in this marketing year. And then on the soybean side, the soybean balance sheet, even with increased acreage of almost 7 million acres in 2021, the balance sheet remains tight. very tight actually. And unless we have just an outstanding year where yields are 55 bushels to the acre or 54 bushels to the acre on soybean side, we're going to find ourselves in a spot where we could need higher prices to ration demand in 2021 as well. Even this year, something's going to happen. We're either going to have to see the cancellation of international sales or rolling those sales to a new marketing year, lower domestic use, so slowing down those crush values, or increased export or imports of U.S. soy, or of increased imports of soybeans to the United States from places like Brazil is going to happen to maintain some of the, or to even meet our needs that we have in 2021. So some positives on the soybean side. I think corn is in a very good spot as well, but certainly I think soybeans have the best fundamentals of the two. So with that, thank you for the opportunity to be with you all. I took longer than I expected to, but hopefully you got some good things out of it, and I'd be happy to take any questions if you have any. So thanks again, and see you next month.
Thanks, Ben. There's already one from Alan Lyons in the chat, if you'd like to take a look at it.
Okay, here we go. Ben, any thoughts on how many jobs will have been lost permanently because of the pandemic versus estimates of new/different jobs that will be created as pandemic disappears? That's a good question, Alan. I can get you the actual number. And I've certainly seen some jobs numbers. The concerning thing, I think, for me, at least in the short term, is it does seem like the unemployment benefits from the December stimulus bill are wearing off, because we're seeing weekly increases in new unemployment benefit applications, and so we've started to see those emerge again. The comment I made about, can we get back to employment numbers like what we saw prior to the pandemic, is going to depend on people coming back into the workforce. We've lost quite a few people out of the workforce that have just decided not to seek unemployment again for whatever reason. And so that's what's, lowered our unemployment rate down to 6.5%. It would be much higher if those people remained in the workforce. So I'd have to do some calculations to get your answer there, Alan. But my guess is we're going to be somewhere down, 4 or 5% probably, in actual jobs when this is all said and done. So. Any other questions? Any questions for Aaron? I don't want to hog all the time.
Take all the time you want, Ben.
I always do.
We were worried we were going to be really short today.
I know.
We both
and then I get long-winded.
We both went longer. It's okay.
All right. Well, appreciate you all joining us, and we'd like to see you again sometime in the future. And wish you all warmth in the next couple of days. Aaron's projecting 50-degree weather. That's what I heard.
Some of us.
Some of them. All right. Very good.
Thanks, everyone. Really appreciate it.
You'll have a good day.
Yeah, you too. Stay well.
Yep.
Bye.
Bye.
Bye, everyone.
Bye.